far, so good. We're looking at an increase in non-current assets, which is an increase in plant and property. We saw where they spent that 100 million, right? Or 90 million. Current assets, by the way, the current assets are those assets that can be easily converted to cash within a 12-month span. So, for example, if you have, the easiest thing to use would be cash in and of itself. Cash is very liquid. You can use it immediately. If, for example, you have your cash tied up in, say, a money market security, it's going to take you a minimum of 3 months to get that cash out. If it's tied up in a bond, probably 10 years. Alright? So, in terms of a company's current assets, that current just means that it can be converted to cash fairly easily. Examples of current assets: inventories. The company can quickly sell what it has in inventory. Even if it's not to consumers, it could always sell them to a competitor. Receivables, which is money that the company is due to collect. You want to see that ideally going down and not up. If money is, if it is, alright, not so intuitive, but if it is going up, what is that telling you? More people are owing you. So you are selling stuff, but people are not paying you. So that doesn't convert to cash. By the way, a company with a high level of receivables, that's a bad sign. Similarly, is a high level of inventories, because it's telling us that you're not able to sell your products.
Sorry, I'm saying that, I was saying that inventory is one of the most expensive things for a company to hold, because it has a lot of cost coming with that warehousing cost and all the depreciation and all that. So.
And he's absolutely right about that. So you don't want to be holding a lot of inventory. And then cash and cash balances, this remains largely unchanged. Now, if you consider the total assets, this varies from company to company, but what you want to see is that they have the majority of their assets in, again, depending on the nature of the company. But for a manufacturing company, the majority of their assets is going to be in long-term assets. So for example, their factories, the lands they own, their warehouses, etc. And now we can look at the total value of the assets. That's 1,333,548,000, which is an increase from 1,123,490,000. So that's good. Can you look at this and tell me, where is the majority of the increase? Is it in the non-current or is it in the current assets? It's in the non-current assets. Because look at the current assets. Current assets basically went down except for this one, which is inventories. Alright? So basically, this is a good sign for a manufacturing company, because you want to see them expanding, building up more warehouses, buying more machines, becoming more efficient. Equity again is just the total worth of the company. We already mentioned that we want to see liabilities going down. Is this a good picture? You're looking at this in terms of the total non-current liabilities. Is that a good picture? It's trending down. Yes. So in the same way, so these are non-current liabilities. So we already talked about current assets. Alright? Current assets are those that can be easily converted to cash. Non-current assets are those that it will take a longer time to convert them to cash. Your non-current liabilities are liabilities that are not due immediately. Alright, so long-term loans, preference shares, bonds, those are long-term liabilities. Current liabilities are monies that you need to pay out within the year. So here we're seeing that payables has gone up by a near 100%. However, the company's bank overdraft is down by close to a factor of 5 times. Which means they're taking less money from the bank in order to finance their operations. What else is also a big ticket item here? This one not so much. Director's accounts is now 0. What possibly could have happened there? This is the director's accounts. So think about it. It is counted as a liability against the company. Why? It's money that the company owes to the directors. So they paid it. Perfect. They paid it off. That 0 is a very good sign. And of course, you can see that the total current liabilities is down. So you're looking for that. By the way, I'm using the sheet now just in the interest of time, but I have the presentation that will show you exactly what to look for each of these points. Okay? I was unable to do it for a manufacturing company. Retained earnings, yes.
What's the system if you're looking at that figure?
How do you interpret it?
Are you looking at it like is it a case where they're paying out less or what does it factor in analysis?
It does. Retained earnings counts as part of the work of the company. It's a part of the equity. So the higher it is, the better. And retained earnings is just that portion of the company's money that was not paid out as dividends to shareholders.
Right, so the question is,
Yes.
how do they do it in conjunction with the actual payout? Is that look at both figures? Maybe I have to look at both figures.
Ideally, I look at the amount of dividends that they're paying. I don't really look at the retained earnings so much.
So that was the first one.
Okay. So you can look more to the dividend because for an immediate, if you want to consider immediate gratification, then you look at the dividends. Long term, though, you want to look at the retained earnings. And then this brings me to the last thing as it relates to the balance sheet. It's called a balance sheet because the sum of the company's liabilities and equities is supposed to be equal to the total assets of the company. Interpreted, what that means is a company pays for its assets either with equity or with debt, liabilities. Alright? So that's what it means. Do we understand that, or do I need to repeat, expound? Repeat? Okay. So the balance sheet is called a balance sheet because it is balanced. It's balanced between the total amount for the assets and the sum of the liabilities and equity. In said another way, a company pays for its assets using either equity or liabilities. Liabilities in the form of debt. Which one do you want to see increase? A company paying for its assets using liabilities or debt? Which one? So, I'm asking you the ratio. So, do you want the company to pay for more of its assets using liabilities or more of its assets using debt? The answer is it varies based on the nature of the company. Alright? And then the last financial statement that we will look at is the income statement. And this is where you're going to see those line items that we talk about, revenue, gross profit, net profit. Those are all on the income statement. Alright, you can also see, well, this is also the earnings per share. Okay. So we start at the top. So top line, by the way, sometimes they actually say top line revenue. Perfect. So we see, what are we looking at? We're seeing an increase in revenues. Is that good or bad? Is it good? We don't know yet. So far, alright. Just using that one line item, then yes, it could be good. But the true story isn't quite told yet. So that's all their revenue, 3,227,000,000. The gross profit is 993 million. Not necessarily a bad thing. So they're basically keeping what? 4% of what they collect. Yes, it is good because we have like benchmarks. So for manufacturing companies, their gross profit, their net profit margins are typically within the range of 2 to 3% because they're capital intensive versus software companies that basically spend nothing to create their income. So they have very high profit margins. Let's see. Administrative expenses increase, but I call that marginal, from 340 million to 383 million. Selling and promotional expenses. This is an interesting one. Really? Just looking at it. Courtesy of the Jamaica Stock Exchange. You're welcome. Yes. Other operating income. It means the company made a loss. By the way, other operating income is income from activities not related to the core business of the company. So say for example, this company decided to take 100 million, right? And invest in a new venture. New venture goes bust, you record a loss. Which means that was a ridiculous loss. Okay, great. You raise a very good point. But alright, before we get there, by the way, the notes are key to the financial statement. So you can never read the financial statement without the notes, okay? And they're in plain English, so that's good. most of the time. So we see selling and promotional expenses here down from 85 million to 79 million. And the question is that good or bad?
Depends.
Depends.
Suppose that the year before they were pushing a product, pushing something. I was just saying that the previous year they could have been pushing something, so they really have spent more on promotion and selling, while in the current year they weren't doing that because
You're absolutely correct. That was when they launched LASM. So that's why it's down. No. The gentleman at the back, what's your name? Watson said, because it is, Here's why. And I'm going to use the case of Indies Pharma. Indies Pharma recently eliminated basically all of their debts. But the amount they started spending on promotional and sales is also down. If they were able to spend more on promotions, you would have seen a far greater return just because of the nature of the business they're in. So sometimes they shouldn't skim on selling and promotional costs. So yeah. Alright, so profit from operations, marginal increase. Profit before taxation is up 40 million, thereabout. It's not bad. It's around 80%. And then see that the tax number come back again. So the year before they were able to actually get, that's a tax credit. Alright, when the tax number is negative, that's a tax credit. Meaning you can write off certain things. For example, that joint venture. They could have written off that joint venture and claim on their deferred taxes for it. The junior tax exchange incentive would have been incorporated in that as well. And the net profit for the year is up by another 187 million. So that's relatively good. We'll see a growth, I assume, in earnings per share. So that's where we will go next. There you go. And that's a significant increase in the earnings. Age? Oh, that's the calculated difference. Yes. They probably wrote it down against your deferred tax assets. So your deferred tax assets, I'm not the best person to explain the deferred tax asset, but it basically allows you to write down against your taxation costs. Alright? And that's it. Oh yes, this is the last item. So the earnings per share would have been the last if they calculated. A note is missing from here, and the note would actually tell you how many shares they have in issue, because the note will explain how that number is calculated. So let me go and find the actual income statement, and I'll be able to show you guys that. That's the we're looking at. What's the problem? People that are active. Let me zoom this, and you will see that it actually follows the exact format, but it also goes into the same numbers. Oh, this is the actual report that they generated. It's not what I'm looking for. I'm looking for the actual number. LASM financial statement, well, this is of 2018. Okay, please forgive me. I'm going to actually use the 2018 one just in the interest of time, because I just want to demonstrate where the notes are and why they're there. Okay, good. The audited financial statements, though, is a very long document. Most of it you don't really have to, I don't want to say care too much about, but a lot of it is accounting jargon based on the financials and the IFRS, International Financial Reporting Standards. Alright? Sometimes, by the way, those standards can change a company from being profitable to a loss-making one, just based on how they decide to write the standards. It can work in reverse as well, of course. Sorry? Yes, I will. Is that good? We can see that? Okay. So, we see where they talk about revenue, and that's note 6. So this is what the actual statement will look like. You do not get the statements as Excel sheets. That is a pain for me. Alright? Because you have to convert, well, sometimes you have to manually put them into Excel in order to run the calculations and see the analysis. Anybody here an auditor? Is anybody here an auditor? Accountant? You get the Excel sheets, don't you? Yep. What's your name in the group? Okay, alright, so we were looking at the last note, which is basically the stock, the earnings per stock unit. It's the same thing as earnings per share. Stock unit equals share. Alright?